JJ the CPA here. We're going to talk about year-end tax planning as it relates to what everybody wants to do, and that's go out and buy toys. What do we mean by toys? I'm talking about assets. So a new copier, a new computer, the new camera. We're going to talk about vehicles separately. We'll talk about real estate separately, but I want to focus in on buying assets at year end. We've got three different ways that we're able to get a full tax deduction for those. One is code section 179, the other is bonus depreciation, and the other is a under $2,500 asset expense opportunity. So let's first start with this. When you get to year end, buy assets if you're looking to reduce your taxable income. And if you think you're going to replace anything or need anything new between now and the end of next year, why not buy it now? Now, first thing you want to look at is, can you afford it? Because you never want to spend money just to spend money to save taxes. That wouldn't be smart in any way, shape, or form. What we're talking about is, what do you need? Do the assessment. Because if you can spend the money now and save the tax now, that might be a benefit to you. So let's just say, for grins, you buy $10,000 worth of assets and computers and a camera and printer and AV equipment, etc. Then you're in a situation where that $10,000 would save you a max 37% on the federal side, so $3,700. So the thing to keep in mind is, spending 10 grand is not going to save you $10,000. It's going to save you whatever your tax rate is. And that's the reason that going out to buy toys or new equipment, so to speak, is not going to save you 10 grand. That's why you want to make sure you need it, want to make sure that you can afford it. Now, let's talk about how you would actually buy that. We've talked in another video about using your credit card. You can. Remember, when you charge your credit card, that's when you get the tax deduction. It's not when you pay the credit card. If you get a note to buy something, so you're at year end and you want to buy equipment, let's just say it's a $50,000 piece of equipment that you need, and you're now going to finance that. If you're in a situation where you've actually financed it, you've signed a note, there's interest being charged, there's monthly payments to be made, because you financed it, you borrowed the money, you get to write it off when you executed that note and you've received the equipment and placed it in service. So signing the note is what's equal to buying it. So if you were to buy it from a vendor and you're at year end and they say, hey, just pay me in January, that is not going to get you a tax deduction in the current year if you're cash basis, because you didn't buy it. Just because you have a promise to pay does not necessarily mean that you get to write it off when you're cash basis. That's just considered accounts payable. So when you're looking to buy assets, make sure not only that you need it, that you can afford it, but that you're buying it before year end. And if you're borrowing the money and you're using a credit card or a loan, that you're executing both of those things before year end. Now, of course, if you write a check for it or pay cash, then you're able to get that deduction. So keep in mind that whatever it is that you spend before year end, you get the deduction this year. Now let's go into the three different ways that you get the tax deduction. One, section 179. So not to be a code head, but code section 179 has been around for a long time. So up to $1 million in assets that you buy this year, you'd be able to immediately expense. The problem with section 179, even though it's a beautiful provision in the tax law, is that you only get the deduction to the extent of your net income. So if you're in a situation where you bought $100,000 worth of assets, equipment, then you're in a situation that if you netted $50,000, you'd only be able to deduct in the current year $50,000, which is to the extent of your net income. Now, what happens to the rest of that deduction? It carries over to the next year. So there are times that that makes sense. It's a good strategy because you're looking to zero out your income in the current year and then take the rest of that deduction into the next year. Now, you might be in a situation where you say, you know what, I need the full deduction now. I don't care if it yields a loss because I have other business interests that have net income, and I'd like that loss to offset the other business that I own and its net income. So then you would take advantage of bonus depreciation. With bonus depreciation, you're able to get a full deduction, and under the new tax law, little ridiculous, but under the new tax law, it doesn't matter if it's new or used, you get 100% tax write-off if you buy it before year end. So 100% under bonus also yields you a deduction, but no limitation to the net income. So you could be in a situation where you don't have a lot of net income. Let's say in that same example, you have $100,000 in asset purchase, but your net income is only $50,000. You'd still be able to, in the current year, get $100,000. There would be no way to carry that over. Only Section 179, to the extent of net income, is allowed to be carried over. The third way is under a provision that came into play a couple of years ago, and very complicated, but to simplify it, if the asset is under $2,500 in cost to you, you can just expense it, meaning it's not an asset that you're depreciating, it's not an asset that you're taking Section 179 or bonus depreciation against. The IRS basically allows you to just expense it. So on a $2,500 asset, let's break that down. Many of you may think, well, I just bought $10,000 worth of computers, so I guess I don't get to take advantage of that. Wrong. What you have to look at is what is each asset's cost. So if you're going to Dell, most likely each computer that you're going to buy is less than $2,500. Let's just say you're getting a supercomputer and it's over $2,500. Well, probably what you bought was a monitor and a keyboard and a mouse, as well as the tower. Well, each one of those is separate assets that you'd be able to expense under the $2,500. In another video where I talked about real estate, if you're in a situation, let's say, where you bought up from one vendor $25,000 worth of lighting, but each light is a separate structure or separate fixture. And if each light is under $2,500, you would get to deduct each light. So check out the real estate video for year-end tax planning. My point in saying that is that there is a lot of opportunity for you to be able to write off assets at year end. Again, when you're doing this, it would obviously make sense to consult with your CPA or with us to ensure that it makes sense. And then if you're going to do the purchase, making sure that you need it, that you can buy it properly, that this would be the right year for a deduction. For clients that have maybe less income this year but more income next year, maybe save that asset purchase for next year. Don't put yourself in a situation where you're just blindly buying stuff at year end where it may not really be the best year for you to buy it. The other thing to keep in mind is as it relates to vehicles and real estate, there's some special rules related to those. So what I'm talking about here is I'm talking about assets. So I'm talking about equipment, I'm talking about furniture, and so included in that would be cell phones, computers, machinery, a copy machine, any kind of furniture, decor. Now, let's talk about software real quick. If you're buying software, and it's an annual subscription, because most softwares are that way now, or it's a software really that you're just going to use in the next year to 2 or 3, you just get to expense that anyway. So now if you're buying a $50,000 software installation, there could be some special rules around that in terms of what the write-off is, but under Code Section 179 and bonus depreciation, you'd be able to get that full deduction if that's what you so choose. All right, hey, thanks for tuning in. Here's some good year-end planning tips. Get ready for the next video, and then don't you ever forget, you've never met a CPA quite like me. Don't you ever forget, you've never met a CPA quite like me.